it's better to just understand that we don't know everything. And when we come across things that we don't know, to ask people for help, to ask questions, and to take the time to research how to respond.
Welcome to Multifamily Insights. I'm your host, John Casman. I want to thank you for joining us for another great episode. If you are an avid listener of the show, be sure to leave us a rating and review. We want to hear from you and make sure that other audience members or other listeners get the great value you're getting. And if this is your first time listening, be sure to hit that subscribe or follow button so you don't miss an episode. We've got a great show today. We're going to be talking to Amy Rubenstein. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Amy, welcome to the show. How are you today?
I'm great. Thanks so much for having me.
Absolutely, Amy. It's great to have you on the show. Listen, I would love for you to take 2 minutes and tell our listeners about who you are and a little bit about your background.
Great. So I started in this business 21 years ago. I was based out of California at the time. My focus at that time was around rent control assets. I've bought all different kinds of real estate and then most asset classes, but really with a primary focus always on multifamily and very specifically distressed multifamily. And in the last 10 years, I would say very, very specifically only on C-class workforce housing. So that is what we love the most. It's what I'm the best at. Although we've dabbled in a bit of everything, office, retail, industrial, ABC classes. What I really find is the most secure and solid through the ups and the downs is that C-class workforce housing. So it's where we stay. So we are currently based out of Chicago, been here the last 10 years, and we are a national company. So we buy all over the US. We buy a minimum size of 300 units, and we usually max out at about 1,500 units per submarket so that we have diversity in geography. And we focus on stabilization and selling. That's generally who we are.
I love it. 21 years of experience in the industry, starting off in, rent control kind of properties out in California, the last 10 years in Chicago, but focusing all over the nation, focusing on distressed assets, C-class workforce housing properties, highly distressed, where you could come in and really add value. That's really the bread and butter. Over the last, 10 years or so, how many units do you think you've kind of managed or rehabilitated?
Oh my gosh, we've done hundreds of deals. It's hard to guess exactly. We never hold a very large portfolio because we buy and sell pretty quickly. So we'll buy an asset, stabilize it and turn it around, and we're done in about 2 to 4 years. We are fully vertically integrated, so we do all of our own management, construction, and back office. So we're pretty intense while we own that property, but we cycle through it pretty quickly.
Got it. So you got a 2 to 4 year hold period, vertically integrated, handling construction, property management, all those things. But you are looking to exit relatively quickly, where it's not really a long-term hold. So let's break this down, right? Because I'm sure people have seen deals that were highly distressed, and many of our listeners are more familiar with value-add deals. What exactly is a distressed asset?
So for us, I would say there's different kinds of distress, and I'm going to, for purpose of conversation, kind of break it into 2 different kinds. And I would say there's a lot of physical distress and then managerial distress. And we really focus more on the managerial side of it. We're not a developer. I would call us redevelopers. We restore value, but we're really not, we try not to focus on the heavy construction. So we're not really on that physical distress side so much. That being said, anytime you come across a property that's distressed, even when it's managerially distressed, that comes with some physical distress. It's just that we're not moving walls. we're not changing the structural entity itself. And we're not building brand new amenities. We're not building new clubhouses. We're not digging up new pools, stuff like that. But we will take on distress physical aspects, such as, a pool hasn't been up and running in 3 years, and so we're putting in all new equipment, or a roof needs a full replacement, or a parking lot needs to be fully torn out and replaced. That kind of distress we'll take on. General rehab of units, but really what we're trying to do is restore the property back to its value.
Yeah, I love the
So
way you just, oh, I was gonna say, I love the way you described that, right? So the way you think of distress, it's not that you're looking to come in and create a brand new vision for a property. You're really looking to restore the property to its former greatness. So again, replacing a roof, you're gonna, fix or replace the swimming pool or whatever amenities are there. You're not coming in saying, hey, you know what? You know what would be great if we tore this down, build up this clubhouse, make this, change this, layout and make it a 3 bedroom instead of the two. You're not doing that. You're really just looking at what's already there. How do we either fix it, make it more functional, and kind of make sure that's operating properly?
exactly. And changing it and adding to it and going up an asset class, that's a valid investment too. It's just not what we do. We're taking it to that point of, here's where this property was meant to be, and we're going to bring it back to that place, and then someone else can come along and buy it and take it up another level.
Yeah, I love that. I think it's
Maxing
really
out the
smart
deal.
to, yeah, I think it's really smart for you to do that, find the opportunities and scale it. You also talked about focusing more on the operational side. So looking at kind of the numbers, the managerial side of things, and looking for distress there. So how would you define distress from an operation standpoint? Are there certain, vacancy or occupancy metrics you're looking for? What do you look for there?
Yeah, so we're looking for things that are not performing as their neighbors are in an extreme way. So occupancy is usually a big issue. Delinquencies are a really big issue. It could be that crime is a big issue on the property. When we're looking at a deal, we analyze the deal itself first, but then we start to really dig into the submarket. And we want to see, what are all the neighbors doing? How are they doing? What is their occupancy level? What do their rents look like? And what are their collections looking like? And how does this market function today? And then we look at this property and we see there's a big delta between where this property is functioning and where the neighbors are functioning. And that's the gap that we're trying to fill in. That's what we're trying to repair. And so today, mostly that is about these three things, which is occupancy, delinquency, and sometimes crime. And that's what we're trying to
Occupancy,
fix.
occupancy, delinquency, and crime. Those are the three metrics you're kind of paying attention to, looking for. You said an extreme delta between kind of the neighboring properties and the subject property. Really important aspects, obviously, making sure that the property's filled, people are there that are paying, but then the people who are there feel safe based on the environment. Walk us through some of the things. So when you get a report or you're looking at a property, you see that there is some extreme, variances between that property and the properties in the neighborhood. First of all, the word extreme could be interpreted very differently. Do you have numbers that you're looking at for that difference? And then once you figure that out, how do you put together the business plan to go about solving these challenges?
So I'm looking at it a little bit different. So
Okay.
you can get to I'll get to the question that you're asking, but I come at it a bit of a different way. So I'm looking at a deal that clearly has problems, and you're asking me to define what are the metrics of those problems. And instead of defining what the metrics of those problems are up front, what I'm looking at is, first I'm saying, okay, there's problems here, and here's the return I need to get for my investors. And so I'm saying, what does the deal take for me to get this return for my investors? And how much does it cost for me to get from where the property is today to where it needs to be? And how long is that going to take? And then I work backwards. So if I put in, it's going to cost me $10 million, and it's going to take me 2 years to get the property from where it is today to where it needs to be. And I need my investors to make a return of somewhere between 30 to 40% annualized based on a 3-year sale. So then I work backwards to get to a price. So that's sort of how I back my way into a deal, as opposed to saying, how far off of market is this deal? So it is important. It's an important metric, but it's not something I don't know that I could answer for you. Every deal we buy is X percentage under market. It's hard to say exactly.
That makes a ton of sense. And that's exactly how we look at, value add deals, right? It's a
Mhm.
similar approach there. Obviously, the returns and the numbers are a little bit
Correct.
different, but that helps me understand when you look at it, there's obviously got to be a big lift in how the property is performing today, whatever
Mhm.
your business plan is going to be, and what that stabilized return looks like for your investors. So I appreciate you sharing that.
Yes.
Let's dig into kind of that approach, right? So you've identified this is a property where it's really underperforming the market. You come in and put together a business plan. You figure out how much money you're going to have to invest in the asset to get it stabilized. For someone listening who says that obviously makes sense, and I heard you say, 30% returns, and maybe that sounds really enticing. What are
Mhm.
some of the concerns that a new investor should have when looking at deals of this nature?
When they're
And maybe
looking to
concerns, and
buy
maybe yeah, maybe
for
concern
them.
is not the right word. So if they were looking to replicate this strategy, what are some cautionary areas that they would really need to pay attention to make sure they don't make a mistake?
Okay, so I can answer this in two ways because one is for your investors who are looking for passive investments. What are you looking at when someone else is saying that they're going to do this versus an active investor? What are you going to do yourself on this, right? So I think your first question was, what do you do yourself? How do you do this yourself? And so, and you're asking what are some of the challenges in it?
Yes.
Yeah. So there's a lot of unknowns, and anytime you're underwriting real estate, right? You're making your best educated guesses, and I would say maybe you have a bit more unknowns on this because there are some extra moving parts and pieces. And so we're going to draw out a trajectory, and that's going to be kind of like a straight 45-degree line. And then you're going to get these ups and downs, these peaks and valleys as you go, right? And you just try to make sure that you're guessing the middle of that. So some of the things that there are some strange trends in the market right now that I think probably I would say most multifamily owners are feeling. One of those big trends is evictions. Evictions are on the rise. It is extreme today compared to what we were used to in the past. And it, I think that there's a lot of causes of this that are related to COVID and COVID relief funds and the world getting back on track, the state of the economy now. But there's definitely a different trend of evictions today than we used to see pre-pandemic. So I would say that is one thing that people really have to try to adjust for. And we're constantly adjusting. I'll say we use certain metrics and assumptions, and every time we do a deal, that's helping us tweak what the assumptions and metrics are for the next time that we're running a deal. So it is an ever moving and living and breathing document, these models that we use to analyze. So the rate of eviction, I would say, is a big one. Another thing is, as you're running credit checks are looking different than they used to look. What do you accept for credit? How much income do you need to have a tenant? And so some of that stuff is ever adjusting. Some of the laws are changing constantly. What can you and can't you deny a tenant for when they come into your building? So these are all things that need to constantly be taken into consideration and reevaluated over and over and over again every time you do a deal. Cost of construction is something that is always a variable. I would say less so when you do less construction. So for us, because we're not doing massive amounts of rehab, it's not as critical as someone who's doing a little bit more rehab than we are. But still, it's always an issue. Prices are always changing. Availability of labor is always changing. So that's something. Uh, the rate of lease up is a variable that is always something to keep an eye on. How quickly are your units being absorbed? This is a bigger issue when you have higher vacancies than when you have lower vacancies. I would say, based on where you invest, rental growth year over year is an ever-changing thing. So a lot of people started moving to the Sun Belt and investing in the Sun Belt You get cities like Nashville and Atlanta and Austin that were very, very overheated, that had a lot of rent growth for a little while, and now you get negative rent growth, or rent decrease in those cities right now. And so that you got to be really careful when you're looking out to what is rent going to look like in the future, because while those were growth cities and they did grow, there was a lot of speculation. We personally try to stay away from speculation, any sort of predicting the future, variables that we can't control. We actually try to not guess at, which I would say most real estate investors do take guesses there. So, excuse me. So, for instance, when we model, this is a little bit unusual for real estate investors, but when we model market rent growth, we actually model for 0 market rent growth in the next 5 years. That is not a typical way to underwrite a deal. For us, it's a way to be very, very conservative. We don't know what's going to happen in the marketplace. We don't want to count on something that we can't control. So we take what the market rents are today, and we say these are where they're going to stay at. You have to be careful there because they could decrease again, right? Other ways that we do this too, you have to be careful about what's going to happen with interest rates. None of us are fortune tellers. If we knew what was going to happen with interest rates, there probably is a better way to make money even than real estate. But we don't know what's going to happen, right? So for us, even though the world is talking about interest rates decreasing, we do not model for a decrease of interest rates. We model for interest rates to stay where they're at and actually to have the ability to go up a little bit on our interest rates. Interest rates are a really interesting topic. I mean, I could go on in that direction, so I'll leave it for now. But if you want to go back there, I'll tell you other ways that we kind of underwrite for that. That could go on forever.
Yeah, let me jump in real quick, Amy. I think you gave some great stuff there. So first of all, when we talk about the watch outs, the theme of what I'm hearing you say is your assumptions. When you are looking at your business plan and your projections, you really have to be careful with your assumptions. First is understanding the eviction rates. Evictions have been going up. So we've seen an increase in eviction rates. Credit checks, how are you validating the potential residents? Construction costs, lease up rate. How quickly can you get residents in this facility, especially if you have a low occupancy right now? And then rent growth. You talked a little about interest rates as well, but rent growth, you model a 0% rent growth. Many people model 2-3%. Usually I see 3%, sometimes 5% and even higher, but you model 0%. So just understanding these projections that you're putting in your model. And I think it's really important to point out for our listeners that because you're vertically integrated, there are other things that you have some control over that would be probably concerning for them. So for instance, if you are an investor, but you're working with third-party management, third-party contractors, these are other challenges or, potential options or areas where you may have exposure. If you can't get the right property management company, particularly if you are in a property where the crime is a little heavy, so you're going to have to work to, do those evictions and maybe move out and change out the tenant base. That could be problematic. So you have to factor these things in. And sometimes that's not something you can just put on a model. You can't model that you're going to have 2 property managers quit every year and need to replace them. And when you change the property manager, 10% of the people aren't going to pay rent because they're going to make up an excuse. Like, there's no line for that on a model. So there's a human aspect of this that you're going to have to work through if you're going to do something that's more hands-on. So there are lots of levels to this. And that's why I think most people focus on more of the value add approach or something that's already cash flowing and already positive. But when you get into kind of the model that Amy's focused on, where it's distressed assets, you really have to change your approach, change your mindset to come in and save something. Not necessarily that's going to crumble and fall away, but you're buying a property or buying a business that's failing. And when you're going into a failing business, you have to bring more resources to the table and have more control over the implementation of that business plan. So I just wanted to call that out because I think it's I don't want people to just sit there and and think that, they can come in, all right, let me just make sure I'm being more conservative on my numbers and we're good to go. There's a human element of being being able to execute these properties as well.
Yes, those are all, everything you said, I completely agree with. It's also very hard. I can't even imagine trying to accomplish this when you don't do it yourself. Using a third party to manage distressed assets, it's almost impossible because the management company, first of all, is only getting paid on collected income. And so there's not a ton of money in this in the beginning for them. And so therefore, they can't put the resources needed towards this property. And so what's going to usually happen is you're just not going to think they're doing a very good job. And it's true, not 100% their fault because they're just not getting paid enough to do it. But they also probably don't have that experience doing it. So it is something that you kind of got to roll up your sleeves and do yourself. It's just not, you can't be very passive about distressed assets. You have to really go in and tackle it yourself.
I think it's great feedback. It's interesting too, just to give a personal story on this. I had a smaller property that was 28 units. When we bought it, it was, cash flowing. There were some things that we felt we could absolutely improve upon. But in doing that, we realized we actually had to almost deconstruct what was currently there to build it back up. And that process was much more difficult than we anticipated. And we went from having a cash flowing asset that we were going to just add value to really having a distressed asset that became very difficult to get back stabilized. We did fine on that project. But I could see how other operators or other investors could really face some challenges there. Can you talk to us about, kind of the origins of these properties you're finding? I assume that many of them at some point were cash flowing and were just fine properties, but at some point they fell into this distressed state. What kind of, properties are you coming across? Like, is there a similar theme that you hear when you take over these properties?
I would say the properties we find usually have distress because the ownership had distress. And so there's a lack of leadership on the management side. And so you see a couple things. You see, first of all, there's not a great direction that the staff is being given to follow, but also there's not money to back it. And at the end of the day, when you've got a lot of distress, you got to put money into it to fix it. It's not that you only throw money at the problem and the problem goes away, but if you don't have the money to throw at the problem is not going to go away. You have to be able to back it. So that I would say it's usually about a distressed ownership that and then that starts the spiraling effect. And so what you generally will see is something like ownership didn't put money into something that needed to be repaired or needed to be addressed. And so some tenants decided to stop paying rent because they weren't getting what they needed. And so then ownership had less money to put back into the property to address more issues. And so more people stopped paying rent and people started to move out. And then all of a sudden, the management doesn't quite know what to do. They're not even able to pay their legal bills. So people who stop paying their rent aren't getting evicted anymore. So more people stop paying their rent because their neighbors aren't getting evicted because they aren't paying their rent. And so then the owner starts to get nervous. And so they say, I need to fill in some of this occupancy. I need to get some rents coming in. And so they start opening the floodgates to anyone to come into the building. So they stop doing credit checks. They stop caring who moves into the building as long as there is a body moving into the building that might pay some rent. And so now all of a sudden the wrong tenants are coming in. And so now you start to get crime building up, but nobody has the money to address the crime. So the crime starts to fester. So people start to know, oh, we can commit crime at this property because nobody's addressing it. And it starts to build and build and build. And the problems spiral out of control. And then there's nothing anyone can do. And now it costs a lot of money to fix the problems. That's
Yeah,
generally what we see.
my goodness. And listen, I think it's easy to see, just one issue. Okay, we have money, we can't fix that. Let's not worry about it. But to your point, this very easily and very consistently snowballs, right? If you don't have the cash to fix these issues, it's going to erode your value over time. So it's just a matter of how quickly it happens, but you have to figure out how to get in front of these kind of issues. We know right now a lot of owners are being challenged right now with the rising cost of interest rates. They are left cash available to do renovations or to fix up their properties, trying to maintain, just occupancy or whatever it is at this point. So there's an assumption that a lot of these deals that are maybe operationally distressed will come on the market over the next 12 to 18 months. What's your viewpoint when you think about that?
I think we've been in a downturn for the last 12 months. I don't think there's any crash coming up, personally. So, yes, interest rates are high. They're not historically high. They're higher than they were before. If you look back over time, these are not crazy interest rates. But if you underwrote a much lower interest rate and now all of a sudden your cash flow is being eaten up by this, you're probably pretty pressed for cash. And so, yeah, you might not have the cash needed to do everything you need to do. I think there's a lot of money sitting on the sidelines waiting for a crash, waiting for things to fall apart. And so I think that if a seller starts to adjust their pricing a little bit to sell, maybe they're not going to make money. But I think they'll be able to get out of their deals because there's a lot of people sitting and waiting to buy. So I don't see a slew of multifamily foreclosures coming up. I just don't think it's going to happen. When I talk about distress and what causes distress, it's more than just a bump in interest rate. That might be the straw that breaks the camel's back. It might be a combination of people didn't do well through COVID and then interest rates, but usually there's something even bigger that started before that. And it's not just the interest rates that push it over the edge. Certainly interest rates can cause a deal from something that looked like it was going to be a really good deal to a deal that's just going to break even, or maybe it loses a little bit of money, or maybe it wipes out some of your equity. But I don't think that interest rates are going to be the sole cause of distress, of people's equity just getting completely wiped out and foreclosures starting to happen.
No, I think that's really insightful and clear, right? It's one thing. There are a lot of different elements that come into play. You went through a whole litany of them before, right? But it's the cash flow, it's the operations, it's making sure you're handling the business. Certainly interest rates can change those projections and certainly may have a bad impact, but it's not to say that every single property is not going to go into foreclosure. So lots of things to keep in mind and pay attention to there. When we talk about finding these distressed deals, how are you sourcing these opportunities? Are you getting them from brokers or directly from owners? How are you going about that deal sourcing process?
Usually brokers are bringing us off-market deals based off of knowing that we buy things that look pretty messy. And it's usually deals that they can't quite put on the market because they're negative cash flowing or they don't know exactly what the building is cash flowing or not. A lot of times the sellers don't even know who's living in their buildings. And so if a broker can't wrap their head around it, it's hard for them to get it on the market. And so that's when they usually will call us. So we typically are getting off-market deals from brokers. And it's based off of brokers seeing what we buy and sell, other deals that we've bought and sell or sold. And they see those deals and then they bring us more.
I love it. And that's it, right? It goes to reputation. You talked about 10 years in this specific, model. When you're out there buying 300, 1,500 units, people are going to see that it's easy for them to call you and say, hey, we got a deal that's very similar to when you bought not that long ago. Even if the numbers are crazy, even if the story is not ideal, like if they know what you buy, it's going to be easier for them to reach out and keep you in mind. So you're going to get those off-market opportunities as opposed to someone who is chasing the same thing that everyone else is looking for. So great insight there is to, one, think a little bit differently, but then two, be able to execute. And if you can do that, you're going to have more deal flow on opportunities there. For those investors who want to learn more, whether it be from passive investment opportunities or just learning more about your business, your website is the clearinvestgroup.com. So it's the Clear Investment Group, but the website URL is clearinvestgroup.com. So you can check out Amy and her team and read more there. Right now, we're going to go to our round of insights. Amy, give me a failure or an apparent failure that sets you up for later success.
I I was an actor out of college, and I started working in real estate to support myself through acting. And I guess my failure of being able to support myself as an actor led me into this career.
That's awesome. I'm glad you failed, I guess. All right. Give me a digital or mobile resource you recommend for your business.
We use citydata.com to do a lot of research on a particular submarket. So I would say that's a pretty good source.
Give me the book you've recommended or gifted the most in the last year.
Ideal Team Player. It is absolutely the number one changing book in our company right now. It talks about attributes that you want your teammates to have. And those attributes are being humble, hungry, and people smart. And we have implemented this into our team, and it's really, really important to us that everybody we work with embodies those three things.
What's a daily habit that helps you stay focused on your goals?
I walk to work every day, rain or shine. It's about 1.5 miles each way. In Chicago weather, if we're -5, I'm walking. If it's thunderstorms, snowstorms, and I think just having that, those 25 minutes each way to clear my head and allow my thoughts to be, and it's kind of my only time that I'm on my own. And I would say that replaces a lot of other needs for me. And I hate going to the gym, so that's the thing I get to do.
What's your number one insight for investing in distressed assets?
I would say what we've learned through the last, few downturns and through buying things that constantly have problems is that we never know what's going to come, and not to get too overly confident about what we do know. It's better to just understand that we don't know everything. And when we come across things that we don't know, to ask people for help, to ask questions, and to take the time to research how to respond. And then to be okay with the fact that every single day is going to bring a major crisis, problem, challenge, and we're going to push through it, and we're going to get out on the other side just fine, as long as we kind of keep clear heads and keep moving forward and keep staying humble.
All right, you are in Chicago, one of the best food cities in this country. Give me your favorite place to grab a bite to eat.
I have to plug all of Rick Bayless's restaurants. He's a dear friend of mine, and I like eating with him at his restaurants more than anywhere else. But I also will say I'm a vegan, and so I would plug Bloom and Planta as 2 vegan restaurants here in Chicago.
Love it. Well, the next time we're in town, we'll put those 2 on our list and check them out. Amy, great conversation today. I appreciate you sharing a little bit about your background, how you kind of got into the business, growing, what you've been focusing on for the last 10 years, identifying these highly distressed opportunities, being able to create value for your investors and your partners, and really understanding what it takes to be successful, making sure that we pay attention to different parameters when you're making projections, but also making sure that you've got control in the execution of that business plan with the team, looking and paying attention closely to occupancy, delinquency, crime. Those are the 3 key areas you're paying attention to when you're looking to implement your business plan. Again, for folks who want to learn more, they can go to your website, go to clearinvestgroup.com. Amy, I want to thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
Thank you, you too.